Hello everyone, welcome back to the macro world. In today's video, we're going to break down what the path forward could look like for the S&P 500 and the Nasdaq heading into 2026. Right now, there's no shortage of noise. You're hearing talks about the AI bubble getting ready to pop. You're hearing concerns about inflation making a comeback. Some people are focused entirely on the liquidity cycles. A few others are watching interest rates. And everyone seems to have a different reason for why markets should either explode higher or completely fall apart. So instead of guessing, today I want to approach this from a very different angle. We're going to zoom out and look at historical data, specifically how markets have behaved during the midterm years in the past. Midterm years of 2010, 2014, 2018, and 2022, they all had very distinct patterns. They're often volatile and full of macro uncertainty, but historically, we've also laid the foundation for strong market performance once that uncertainty starts to clear up. As you can see here, we've had two strong closes and then two bearish closes on the year. So we'll talk more about this. What we'll do is walk through the last four midterm cycles, look at how SPX and NASDAQ reacted. Let's see if we can highlight some similarities. The goal here is to understand the broader framework the market tend to operate in during these type of years. And once we understand the context, we'll bring it back to today. We'll layer in where we are with rates, inflation expectation, and positioning right now. Then we'll jump into the charts and see what kind of paths actually make sense from here onwards. In 2010 and 2014, we had some really good double-digit growth, and 2018 and 22 turned out to be bearish closes. Now, it is very important to understand the context, because if you just look at this, you probably think that there's a 50% chance we close red on the year and 50% chance that we close green on the year if we only look at these four data points. But if we have to really look into the context and understand what happened those years, let's start by 2010. We were coming out of the 2008 market collapse of almost minus 40% on SPX, and that is the exact time frame when we started to do some major liquidity injections into the markets, and it makes sense that we closed 13% on the year. Moving forward, the growth accelerated and we continued to close back-to-back years that were very bullish, very green, and the market was just starting to feel the strength of liquidity injections. The year 2018 was going really well. We had some red months, but overall we were supposed to close green, but we had the government shutdown in the last minute of December. And if you were in the markets, you probably remember how fast we came down, and that made December close at minus 9%. And if this month at least closed flat or maybe 1 or 2% up, the year would have closed in the green. So overall, there is a strong reason for the market to close in the red during that year. And if we go forward towards 2022, we had this negative almost 20% because we had this huge acceleration after the COVID drop. Inflation was tapping 7, 8, 9%. Markets were going crazy in 2021, and it was only a matter of time that the bubble pops and we get some kind of pullback. You remember the GameStop saga? Everybody was invested in the stock market and the market needed a correction. That is also the same time when we flipped from QE to QT. We also flipped from rate cuts to rate increases. So market was supposed to feel some type of shock. So the reason I'm going over this year over year is because it's very important to understand the context of what happened and why it happened. I personally believe that we can predict that the midterm year should close bullish. It is in the favor of the government to keep the people happy, make sure that they're feeling wealthy so the votes are in their own favor. But there are times when we are just in that part of the macro cycle where a pullback is very necessary and there's nothing you can do about it. Now, let's draw some similarities in all of these years. The one major thing I've noticed on all of these years is that we had some type of major drawdowns. In 2010, we had an 8% and a 5% back-to-back pullback. In 2018, we had a 3% and a 2% pullback. And down the road in October and December, we had 7% and a 9% pullback. In 2022, we had 3% back-to-back, 8%, 8%, 4%, 9%, and a 6% drawdown. Now, in 2014, we didn't see anything major outside of this little 3%. But overall, understanding that there are times in midterm years where you can see some serious drawdowns gives us an opportunity to position for it. Now, I personally think that year 2026 will close in the green. First, there's still no sign of the AI bubble in my opinion. Earnings are doing really well, inflation is getting in under control, and our sitting president will do anything in his power to make sure that the stock market is fully supported and the housing does not crash. So the question remains, how can we get a bullish close on the year? And I personally think that the path we're going to take is from the 2010 textbook. I think we'll have normal months and then we'll have a major drawdown like a 8, 10, 15%, anywhere from January all the way to August timeframe. We'll get this type of drawdown just for us to recover all the way back up and then continue higher. So maybe not a double digit year, maybe a 8 9% close on the year, but I think that that is safe to say that we'll have a drawdown and then markets will continue to go back up. But I don't see a 2014 scenario happening. I don't see a 2022 scenario happening. I think a 2018 scenario is possible. Ignoring this last government shutdown month, which was a negative 9%, I think we'll just close in the 5 to 8% range. And a 2010 scenario is possible where we get a major drawdown somewhere in first two quarters and then close bullish again, 6, 7, 8, 9, 10% close. Not sure where we end up. But what I'm really trying to emphasize is the drawdown that is coming in the next few months. We already have uncertainty brewing with the Federal Reserve. Jerome Powell is supposed to leave by May. We have the tariff case in the Supreme Court currently. We also need to see if inflation really stays down or will it accelerate back up again. So overall, this is my personal base case scenario, a drawdown and a green close on the year. Let's jump onto the charts and see what we can figure out looking at SPX and NASDAQ. SPX weekly chart is looking pretty good. Let me draw the 7,000 number right here because I feel like that is the number that is turning into a magnet for call options. We have this bull market support band which is extending towards 6,700 now. Notice how we have been above it in every bull market and we keep bouncing on top of it. The moment we close below this 21 weekly exponential moving average, the bull market is over and then we stay under it until the market turns around again. So far we're doing pretty well. I still think the market wants to pop above 7,000 before any type of pullback. But if we look at the 4-hour chart, you'll notice that we are creating this ascending wedge which usually breaks to the downside instead of pushing further up. But because this is the SPX index and not an individual stocks, I have my hopes up that we will continue to push higher. But even if we do get a drop here and the market comes down lower, I think we will either sweep this weekly level at 6,800 or this weekly level at 6,700 and then push back higher. And if I go back to the weekly chart, let's zoom in here for a second. If we do sweep the 6,700 level, we'll only be tapping into this bull market support band, and the next break higher above 7,000 will be stronger than we can possibly get over here. Because if we break right here above 7,000, I think we will hit break somewhere around here and get a pullback anyways. So if we reject before 7,000, I think this will make the chart even stronger and we'll have legs on the rally once we break above this level. So I'm watching this part very closely on the SPX chart. Let's move on to the QQQ. Now the QQQ chart looks even better because this is looking like a breakout setup. We have this wedge formation that kind of broke out with this weekly candle, but we are trying to retest this again. I am not sure yet if this was a fake out and then we continue lower to tap into the support band and then rally back up, but we will have to see. Let's zoom into the 4-hour chart instead of the weekly chart and see if we can get some more information here. And yep, if you look at this, we are consolidating right on this breakout line. Either this is a fake out and we come down lower, or we break out above this distribution area that I noticed. There's a lot of sellers seem to be sitting here. So if we can break above this and trend higher, that would be great. And we will continue this push. This will also give us the opportunity to break out above the 7,000 region on SPX. And if we don't break out here, we get a pullback lower. I think we will sweep this particular level, which is the 600 on QQQ. Also lines up with this weekly candle, and we tap into this region and then push higher again. But we'll just have to see how this turns out. Let's go back to the SPX chart on the weekly time frame. We are trying to predict the next 12 months of price action. That isn't going to be easy. We'll have some time periods where we get very confused, but overall I think that 74 to 7,500 region is very possible by end of year. and that is not too far up. I am personally ready for some vicious rallies that get retraced right back. And if you also take a look at the previous swing high of about 6,100 on SPX, this level is going to get tapped eventually down the road. There is a scenario where we go above 7,000 very briefly, come back, get a major crash like action, and by the end of the year we're closing above 7,400 level, and the year will look just fine. But there's also a scenario where market just comes down here already in the next 2 quarters, and then we go back up higher again. But I do not see a scenario where whatever happened in the price action here and we come all the way down in a crash like manner and everybody says that the AI bubble has popped. I think we are far from that just yet. We will see how the year develops in the first 2 quarters, and we'll make better prediction, and we'll try to be ahead of the market. But personally, for myself, I'm trying to look for swing positions that are very oversold, so my downside exposure is very low. And I'll zoom out one more time just to show you why I said that we need to retrace towards the 6100 level. If you go as far as even 2014-15, we always tap into the major previous highs. Notice right here we pulled all the way back into 3500 level, and then we created this swing high, came back during the tariff drop, and then retested this area. So I'm expecting that this pattern holds down the road, unless charts decides to shift over time, and of course that's always a possibility. But for now, we'll work with the data we have in front of us. I personally dollar cost average every month into ETFs. I don't think you can ever predict exactly where to enter, so I think that is the best strategy you can use for your retirement accounts. But as far as making money in the shorter time frame goes, you really got to understand the cycles of SPX and NASDAQ to understand when is the best time to invest, because there are always going to be stocks that are oversold at some part of the cycle, and it'll be great for you to put some money in there for swing positions for 6 to 12 months and see if you can close the year with 40-50% return on some of the riskier investment accounts that you create. So dollar cost average in is the best recommendation, not financial advice. And I think if you can understand the market cycles, you start looking for stocks that are oversold, it is a good idea to create a separate account to invest into those for swing trades and make some extra money on the side. So with that being said, I hope you like the content. Please leave a like and subscribe to the channel, and I will catch you on the next one.